Good morning. This is David from Trader Dale's, and today we're going to talk about a trade that we did this past Monday, May 18th, 2026. It's a trade that I classify as a draw on liquidity trade. Okay, it's a very high probability trade. Typically doesn't have the high risk to reward, 3 to 1, 4 to 1, 5 to 1. It's typically going to be in the 1 to 1 to 2 to 1 ratio. The one I'm going to show you today actually had a higher risk to reward. But this is a trade that you can really utilize almost every day as long as you have an idea of where price is going. Okay, meaning what liquidity levels, whether they're a kill zone high or low, a pivot high or low, maybe a fair value gap. This is a very powerful pattern and a tool that you can use. And really, it presents itself almost every day. So let's kind of dive into here and show you what I'm talking about. So a draw on liquidity trade, okay, is basically a trade where you have a clear move in a certain direction with a clear target. In this case, it was Asia lows, kill zone lows, which are overnight lows right here on Sunday, May 17th, before we came into the market on the 18th. Okay. And, whatever you did above here, got short, traded down into it. Typically when we get into that 11, 12 o'clock midday range, we tend to accumulate. So basically what we're looking for is some type of accumulation, manipulation, distribution setup into that draw on liquidity. Okay. And a lot of times what's going to happen, and you see here, when the draw on liquidity is not reached, okay, and price consolidates, or in this case, tries to induce early buyers, okay, into the market, okay, creating trend line liquidity here, we get a nice accumulation of price right above that level, okay? So in this case, in a short situation, okay, you're going to look for some type of accumulation, a manipulation of that accumulation, and then a distribution to the draw on liquidity. Let's just say, for argument's sake, it's this red line. Okay. Now, on a long scenario, you would be looking for some type of accumulation, manipulation, and then distribution move into that level. Okay. So the example we're going to show today is going to be a short trade. Okay. And I have the NQ and the ES up at the same time. So what we're looking for is a clear draw on liquidity, which is Asia low. Check. We're looking for some type of accumulation and manipulation, okay, above that level. Here we have the accumulation. We've got trend line liquidity built up. This is engineered liquidity when you have so many clean touches here. Okay, this is the market engineering liquidity. You're bringing in early buyers to the market. You're also inducing more sellers to come into the market, anticipating a move lower. And what you're basically looking for, like I said, is an accumulation, a manipulation with displacement, which we get here, okay, and then a momentum change in order flow, inversing that fair value gap at the same time, okay, targeting that level. Accumulation, manipulation, distribution, okay? What we want to trade is the distribution. So in order to trade the distribution, we need to identify accumulation and manipulation first. And when you have an accumulation and a trend line, and a so obvious trend line, and then a manipulation of this trend line, meaning a displacement out and then a displacement back through, an inverse, that is the tell and the key that this is a manipulation move, because now the order flow has changed bearish and disrespected bullish on the way to your target. Okay. Another added factor is if you look at the ES, we have this red line here. One's pointing up, one's pointing down. This is a divergence. It's an SMT divergence, meaning this high right here did not take at this high, where on the ES it did. Okay, that is another confluence of manipulation. And when this all happens in the direction of where we want to trade, you now have a very solid draw on liquidity trade. Okay, the parameters of the trade will look like this. It is a market order right at the close. Okay, you're going to target at least that low. And on this case, your stop is probably going to be right above that candle that created the inverse right here. So this was just shy of a 3-to-1 risk to reward trade. On a situation like this is probably going to be more of the higher end risk to rewards when you get on a draw on liquidity. Sometimes they're just going to be 1-to-1, maybe 1.5-to-1. Occasionally, depending on where there is or depending on how good the setup. This happens to be a fantastic setup. So that's why the risk to reward turned out to be almost 3-to-1. Okay. But the key is that these are very, very high probability trades. If you can identify them and if you can be sure on where price is going, these trades tend to have over a 90% win rate. Okay. And if you can identify them properly, okay, they can be very powerful. And you can use this on any draw on liquidity. And meaning, if you believe and your research tells you and your analysis tells you that price is going to price discover and take out a certain level, whether it's a pivot high or low, a session liquidity, which in this case was Asia overnight lows. It could be trendline liquidity. It could be a higher time frame fair value gap. If you know or feel comfortable with the draw on liquidity, these patterns can be very powerful. Okay, and as you can see, you could have taken it on either one of the indices. Typically, me personally, I prefer to trade only on the NASDAQ. So I will trade all of my trades on the NASDAQ no matter what. Now, typically when you have a divergence, you want to trade the weaker one for a short side. In this case, this did not make a new high. So on this case, you would want to trade the NASDAQ anyway. Okay, because the NASDAQ wound up hitting its target where the ES did not, even though it did have a nice move down. Okay, so again, this is what I call a draw on liquidity trade. It is when price has been trending in a certain direction or moving in a certain direction, already showing the intent. Okay, and before price gets to a key level, it consolidates, induces early buyers, or on the short side, induces early sellers, and then forms an accumulation, manipulation, distribution pattern into that level with an inverse fair value gap, which is our entry model. Okay, it's our entry model because an inverse fair value gap shows what's being respected, okay, and disrespected. And in order for price to go down, we need bullish fair value gaps to be disrespected and bearish fair value gaps to be respected. And that's exactly what's happening here. Okay.
Hey everyone, it's Dale here. I hope you enjoyed the video. If you like to trade alongside me and our team of prop firm funded traders every day, then click the link below the video and hop aboard. We are looking forward to trading with you.